And again, that's something that doesn't get talked about a lot. And I think a lot of, frankly, a lot of investors, they get hypnotized because the guru talks about like all the great ways we're going to make money and everything's going to look good. And, this is what our exit cap is going to look like. And I've seen some deals where the exit cap rate is actually lower than their starting cap rate.
Are you tired of trying to keep ahead in the rat race, only to have so much of your hard-earned money going to the tax collector? Equity doesn't pay the bills. Retirement savings don't pay you now, and there are only 24 hours in a day to work. The only solution is passive income that pays you 24/7 now, not 40 years from now. From vetted investment opportunities to tax savings strategies, let John guide you through all the confusion and take control of your financial life in pursuit of financial freedom. So sit back, relax, and welcome to the Wealth and Freedom Nexus.
Are you tired of gambling your hard-earned savings with the casinos of Wall Street? Don't you wish you could generate passive cash flow from tangible assets that produce proven in-demand products? Our friends at AgroNosotros allow passive investors to participate alongside them in their sustainable agricultural projects. So now you can caffeinate your cash flow with the second most traded commodity in the world after oil, coffee, and sweeten up your returns with high-end artisanal chocolate. Diversify your portfolio and participate in coffee and cacao farms in Panama that are turnkey, managed for you, with farming, processing, and product sales all done for you. And you impact the lives of subsistence farmers by helping provide housing and education through their socially sustainable programs. To find out more, go to wealthandfreedomnexus.com/coffee. That's wealthandfreedomnexus.com/coffee.
Taxes are your biggest expense. The best way to reduce your burden is real estate. Increase your income with amazing returns and reduce your taxable income with real estate write-offs. As an employee with a high salary, you're devastated by taxes. Lighten your burden with real estate tax incentives. You can offset your income with a W-2 job and from capital gains. Freedom Family Investments is the experienced partner you've been looking for. Our Real Estate Insider Fund is the vehicle. This fund invests in real estate projects that make an impact, and you can join us with as little as $50,000. Insiders get preferred returns of 10 to 12%. This means you get paid first. Insiders enjoy cash flow on a quarterly basis, and the tax benefits are life-changing. Join the Freedom Family and become a real estate insider. Start on your path to financial freedom through passive income. Text FAMILY to 66866. That's FAMILY to 66866. This is not a solicitation. Please text regarding this opportunity for complete details. This is for accredited investors only. Hello, and welcome back to another great episode of the WFN podcast. Geez, where's the time go? It is June 28th. We are halfway through 2023 with episode 89 here dropping. Man, it just seems like it was January, and at least here in Minnesota, 20, 30 degrees below wind chill, and oh boy, how much snow did we get? 90 inches, I think, this year. But that's a whole nother talk track. But anyways, I wanted to do something kind of mid-year and wanted to keep this one a little bit more just conversational. Obviously, I try to bring on a lot of guests to bring on more educational pieces, topics, whether it's debt refinancing or trust deed investing or opening up an HSA or self-directed retirement account, just to name a few topics I've had on this show since I debuted in 2021. This one, I kind of wanted to keep a little bit more conversational, but also wanted to kind of address a topic that I've seen time and time again with a lot of gurus out there, if you will, where if you've been on, Bigger Pockets or Facebook groups for any length of time, you've seen, well, you got to go to multifamily. You can scale faster. It's more roofs, or more doors under one roof, and you can get better financing and partners and syndications and, skyrocket your wealth in record time, et cetera, et cetera. And to be fair, there is certainly some truths behind that. If you want to get a multifamily, let's just say 100-unit apartment complex, yes, you'll probably have to get some financing, some investors involved. I don't think a lot of us just have, I don't even know what a 100-unit apartment would go for, even here in Minnesota, but let's just say $10 million. I don't think a lot of people have $10 million just lying around in a bank account for that purpose. So, then it kind of goes into syndication, getting more investors on board to take down a large project, do a value add, et cetera. And then you have 100 units, like I won't say instantaneously, but a quicker closing than, your ones, twos, threes, with a single family home up to a fourplex. Now, on the flip side of this, which a lot of, finance people don't talk about, is yes, there is scalability, but there can be a lot of hiccups along the way. Obviously, you're taking a lot bigger project down. And over the last, I'm just going to say 5 years, we've really seen the cap rates of multifamily get compressed so much as so many operators, so many investors have dived into this marketplace. For the life of me, I still cannot find this article. I just briefly passed it, skimmed it, if you will. I want to say June of last year, that it was an Austin, Texas multifamily project sold for a 2 cap, which just blew my mind. And it's like, well, how in the world are you going to, value add or exit out of that one? And who knows what that multifamily operator is doing now. But you probably see in the news, and I'll have some links in the show notes, where there is starting to be a lot of defaults in the multifamily space. We've seen interest rates go from, 2, 3, 4% when the Fed was just pretty much giving away free money. And then they had to do an about face, early to mid 2021 2022, and really start to ratchet up interest rates to try to keep inflation at bay. And a lot of these multifamily syndicators were betting on, if you will, that, we're going to take this property, we're going to have some short-term debt on it, 2, 3, 4, maybe even 5%. And hey, we'll refinance. And even if rates go up a little bit, I think we still got some wiggle room. Well, little bit turned into 7, 8, 9%. And, we're starting to see a lot of this. I've seen numerous stats where there's billions of dollars worth of commercial multifamily real estate that is coming due. They either have a balloon payment or a rate reset coming up here in 2023. And I think it's almost guaranteed there's going to be some more defaults in the space. And hopefully some other wise investors are going to pick up some of these bargains, as they get foreclosed on, go back to the banks, maybe purchase these assets at numbers that make sense. Thinking back, in fact, in 2021, and this is actually how I met the guests that I have on today. This was at this Summit on Sand with the real estate guys back in Belize, which was 2 years ago. And one, real estate investing, I'll just call him an icon, Ken McElroy. I remember him saying on stage where he, I think he's got around 10,000 doors nationwide in the US, and his company, they actually started to sell some just because he couldn't believe what they were getting offered. It's like, we'd be dumb not to sell the asset at this price. And with the cap rates compressing, the numbers not making as much sense, he and his partner kind of just took a step back. It's like, hey, we're not doing any acquisitions. And I myself looked at this. It's like, well, geez, if one of the smartest guys I know in the multifamily space is kind of taking a breather, maybe I should too. And I should say breather because I never really got into the multifamily space. Even my syndications that I invest with through my self-directed retirement accounts, they've been in, some alternative assets like self-storage, agriculture, looking at some assisted living projects outside of the multifamily arena. So with that, I'm kind of reminded of an old adage by Warren Buffett: be greedy when others are fearful and be fearful when others are greedy. And that 2022, and here to 2023, started to see a lot of that greed in the multifamily space. And I think it's starting to taper off. I think it will still continue to taper off. So with that, I kind of wanted to bring on, like I said, a more conversational piece, multifamily versus single family, pros and cons of each, and why my guest and I, Sep, who I met at the Summit on Sand 2 years ago in Belize through the real estate guys, he's a big proponent of affordable housing, but also single family homes. And yes, while it might not be as scalable, there's a lot of benefits to single family over multifamily. I'll just quick mention too, with single family, you can get 30-year fixed rate loans through Freddie and Fannie Mac that are essentially subsidized by the government. But even my real estate portfolio, my highest interest rate is 4.5%. My lowest is 3.875. And that is locked in and fixed for 30 years, where a lot of times in the commercial space, it might start off as a lower interest rate, but it might have a rate reset after so long a time. And maybe it'll have, just kind of throwing on numbers, maybe a 20-year amortization, but there's a balloon payment on year 5, year 7, maybe even year 3, where, hey, you'll make these payments for 36 to 60 months or whatever the term is. And at the end of that, you have, hence it's called a balloon payment. You have to pay the balance all at once. And a lot of these syndicators thought, well, even if rates stay the same, we'll just refinance and start either a new clock or maybe a 10-year fixed note or something like that. And kind of the old adage, when you assume something, things can happen. Also with multifamily, keep in mind, if you are looking to exit from multifamily, like I said, not a lot of people have just $10 million just lying around. It's not like a single family home. Hey, I want to buy this, $200,000 property. Hey, I qualify for FHA financing. I only need to put down, 3, 5, 10%. Okay, I just need to come up with $20,000 out of pocket. I'll finance the rest of it. A little bit different in the commercial space, where if you have a single family home, you have a lot of exit strategies. Say it's an investment property. You can sell it to the tenant, do like a contract for deed or a lease to own purchase agreement. It's like, hey, you've been making these rent payments for so long. What if you want to become a homeowner and maybe, we add on an extra $100 or maybe we redo the mortgage or the rent and there's a principal buy down, we factor in something like that. You can sell the home to another investor. They want a good yield for their return. Good yield return for their money, they can buy an investment property from another investor. But probably the biggest thing with single family homes, and we've just seen such a huge demand because of an undersupply of single family homes, you can sell that also to a first time home buyer, maybe to a retired couple. Maybe they're looking to downsize. Their kids have moved out. They've retired from the workforce. They don't need a huge McMansion. They want to scale down to a 3-bed, 2-bath in the suburbs. So you have a lot of exit strategies with a single family home versus multifamily. You're pretty much left up with investors that are going to look at the numbers. I won't say don't care where it's at, but the logistics, the things that people look for in a single family home. Hey, does it have a nice white picket fence? Is it close to a school, etc.? Multifamily, it's pretty much you're left up with what other investors am I going to sell this to? And what are the numbers of the property that they're going to look at as far as determining what their offer price is going to be. So with that, we will get into my interview with Sep Bekam Investments after a word from our valued sponsors.
Are you a podcaster who finds yourself drowning in an endless task that goes into producing a show? From editing to creating show notes and audiograms, it can all be overwhelming. But what if we told you that Lightbulb Podcasting has a solution to make your life easier and your content even better? With our exceptional services and top-notch support, we can help you create captivating content that will keep your listeners engaged and coming back for more. So say goodbye to long hours spent editing and creating show notes. Say hello to more time to focus on your creativity. Let us help you bring your show to life in a way you never thought possible. Visit us at www.lightbulbpodcasting.com and discover how we can help take your podcast to the next level.
Hey, Sep, good to see you again. How are things in California?
Great, John. Thanks for having me back again.
You bet. Or should I say the People's Republic of California? I don't know if they've done the official name change yet or not.
Yeah, not yet, but there's truth in that name.
Yeah. So yeah, good old Gavin Newsom. Every time I think Tim Walz is bad, it's like, well, I guess it could be worse.
Careful what you wish for.
Yeah, I know. Yeah. So, but anyways, I know we had spoken off camera, we've had a number of conversations, emails, and I know you and I both are we like the single family. We've invested in single family for years. And yes, there is some pros and cons of multifamily, but I think there's a lot of I think you put it best, gaslighting among the industry where, oh, you got to sell all your single families, you can't leverage up, you got to buy a 100-unit apartment complex, yada, yada, yada. But I think we share a lot of thoughts, but I'm kind of interested to get your take on, why you've really stayed with the single family.
Yeah, well, an analogy that I'll share that comes to mind. Have you ever seen the movie Revenge of the Nerds?
No, I have not. I'll have to add that to my wish list. So
Okay, I'm aging myself. It's an 80s comedy, right? So it hasn't aged well. You could probably get the gist of the movie just by watching the trailer. But essentially, the movie, it's about this university, and I'm going to relate this to the topic. It's not totally out of left field. But it's about this university, and there's this, fraternity, and it's the jocks, and the jocks, they're all good looking, and they've got the nice cars, and all the sorority girls want to be with them. And then there's the nerds, and the nerds, it's this own separate group, and they don't have the girls, and they're wondering like, what are they doing wrong? And the jocks they just keep making fun of the nerds. They just keep pulling pranks on them, and there's this ogre looking jock that he has a funny line in the movie. It's just nerds and like beating his chest, right? So it's kind of funny because that's kind of what reminds me of single family and multifamily. The single family investors are the nerds, and well, you have to watch the movie. So the multifamily investors kind of remind me of the jocks, and I shouldn't say the investors. It's more the gurus.
Sure.
And it's because the investors, they're just passively investing and making a return, right?
Yeah.
But a lot of the gurus, like kind of like in the movie, they have to put down the nerds instead of just doing their own thing. So, the thing with the gaslighting is just I'm noticing a lot of multifamily that, it's like it goes in one direction.
Mm-hmm.
A lot of multifamily syndicators and gurus, they say, oh, I did single family before. Yeah. And I saw the light with multifamily, but you don't see a counter to that. There's no Grant Cardone of single family, right?
Exactly.
So yeah, we can go into that.
Sure. Well, and I think to be fair, I'm not going to, and I don't think either one of us want to completely knock multifamily. I do think there's pros and cons, and maybe just high level, you mentioned with syndication. Now, you or I might not, have, pick a number, 25 million just sitting in the bank. It's like, hey, we can buy this 100-unit apartment complex. But through syndications where a lot of these, gurus, you called it, they raise money, you and I put in $50,000, another investor puts in $100,000, and basically share in the appreciation, tax benefits, et cetera. And I think probably the top two I've heard where, if you have a house and it's vacant, it's 100% vacant. But if you have an apartment complex, you have one vacancy, it's only 1% vacant. And there are some economies of scale. You have one roof to worry about on this big apartment complex versus 100 individual roofs on all these single families. I mean, I think that'd be a fair assessment to start with. Do you think?
Yeah. So, and I've heard that analogy used before too. Two words that are lacking from the vocabulary of the guru that pushes that is the word portfolio and the word package. Yeah. They think that single family is just buying houses off MLS. Yeah. And they've probably never heard of Invitation Homes, Progress Residential, American Homes for Rent, like these big Wall Street companies with 50,000, 70,000, 80,000 houses, right? Mm-hmm. The CEO didn't go buy one house at a time. Right. They bought bulk from banks, from foreclosure. They trade with each other. There's multiple brokers that will sell those. And that's kind of like how I like to buy the houses too. I buy both. I mean, my company, I should say, packages and individual. I agree that there are economies of scale. So just a little background, I started out as a multifamily investor. I didn't get to, 25 million units, but I started out with fourplexes and then got into, larger apartment complex. Okay. And those were more like challenging, right? But I've seen deals go full cycle. So I can speak from both sides. And actually, I think having multifamily training or multifamily experience makes you able to handle a lot of other asset classes. Because I think multifamily is one of the hardest because you're basically focused on that NOI for the property, right? The net operating income. And if you have just one house, you don't necessarily have to worry about the neighbors. But if you have a 100-unit apartment complex, especially with multiple levels, if you have neighbors not getting along, if you have those types of things, it affects the occupancy, right? Right. So you can do that. You could do a lot of other things. I mean, compared to like a 100-unit apartment complex to like a triple net lease McDonald's, it's as long as that McDonald's not in Atlanta or,
Portland or somewhere. Yeah.
Yeah, the Chaz zone or whatever it is, or Chop, whatever they call it, or whatever the next one is. As long as it's not over there, then it should be pretty easy, right? But a lot of the investors are gravitating towards value add type deals just because you can get more ROI when you're open to having like a higher risk tolerance with that.
Right. So
go ahead.
Oh, I was gonna say, we won't name the gurus, promoting a lot of this, but I think, what I've seen, like, when we first met in person at real estate guys in Belize at the summit there, even then the whole talk track was, hey, we'll find this, depressed mom and pop investor, we'll buy this apartment, value add, we will lower the expenses, increase the income, given the market rates, yada, yada. But I think at the end of it, there was always like this pivot of, well, we're going to do this. It's a 3, 4, 5, 7, whatever year time frame. And then we'll just refinance and return all the capital to the investors. And on paper, it sounds really good. And I think we've maybe been lulled into a, sense of security where, for, almost 2 decades, rates are just going down, 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 down. And now we've had rates just pretty much just about double within 12 months. So I'm curious, what are your thoughts where, I know you and I talked online. I saw a multifamily in Austin sell for a 2 cap. And it's like, okay, are you hoping for a 1 cap on the refinance or what? But, as we start to, this bridge debt, this short-term debt, this balloon debt starts to mature. And if they're banking on refinancing, well, now instead of 4%, it's 8%. How's that all going to play out?
Yeah, well, that's an intelligent question. One of the other, pros and cons with each, right? Like with multifamily, I think you can generally get lower interest rates compared to like commercial loans on single family. It tends to be lower, right? But it tracks, I don't know if it was the US Treasury or I forgot what index it tracks to, but yeah, if the rates are low, if the Fed is artificially keeping rates low, as we've seen the last like 10 years, pre-2022, then you'll have cap rate compression. And I think a lot of the syndicators and investors that got into those deals thought, well, it's going to be like this for the next 10 years, right?
Yeah.
But those interest rates aren't locked. I mean, they might be fixed for 5, 7, or 10 years, like you said, but not 30 years. It's not
right.
30, a bank is not going to give a loan 30 years fixed on an apartment complex. I know some syndicators that have had like USDA loans. Don't ask me why the USDA is loaning on multifamily, but apparently that they can do that. And 40-year amortization, fully fixed. I think FHA, if I'm not mistaken, will do it. But those are grueling loans, like 6 months. And they're not easy, right? It's very strict. There's also low income tax credit type loans. But yeah, that 2 cap property in Austin, it's probably not, at USDA financed or FHA. So yeah, that's definitely a concern. And the investors buying these complexes, let's say if it's at their rates were at like 4% before and cap rates were whatever 5, they do the value add and they think, hey, we can double the net operating income, we can make a crazy good return on the deal. Well, if cap rates go up in that 5, 7, 10-year period, if rates double or if they triple, then they're doing all this work just to give the property back to the bank at the end of the day, or potentially have to come cash to closing, right?
Exactly.
Versus a single family, I would take a 30-year fixed loan at like whatever rate it is, just fixed, right?
Yep.
If I think the inflation is going to keep going up and if I think the rates could potentially keep going higher, I'd rather not have to worry about panicking about cap rates and interest rates and just hoping that they stay low, because the right thing to do is to have the rates go higher, right? I mean, that's what Volcker did in the 80s to fight inflation. I don't know if this Fed chairman is going to do the same thing, though. It might be a bluff, but you're prepared either way if you fix it in and lock it in for 30 years.
Yeah. Well, I know it's kind of interesting. I had watched just enough to get me nauseated, the exchange between Senator Elizabeth Warren and Jerome Powell with raising interest rates. And she's like, oh, it's doom and gloom. We're going to have millions of people unemployed and we're going to have a great depression and yada, yada. It's like, okay, yeah, things got a little bad in the late 70s, early 80s, but it wasn't a great depression. And we had double digit, interest rates. So it's just the hyperbole, fear mongering, whatnot. And so, but I know I kind of chuckle with the Fed. It's like at the end of the day, I think they almost get I mean, eventually, yes, they will have inflation under control. We'll get back to normal, and then they're going to be all, happy. Like, look what we did. It's like, well, it's like the arsonist getting credit for putting out his own fire. I mean, you you do all this quantitative easing, you flood the market with money. Gee, where did all this inflation come? Oh, I guess we got to tamper back inflation. So I don't know, but I know I think you and I could probably have a 10-hour long discussion on the Federal Reserve as it is. So
yeah, if I can make one plug for a book on that note, John, and you might have read this book, Murray Rothbard's America's Great Depression.
Oh, I actually have not.
It's a really good book because that exchange that you just mentioned kind of reminds me of, Warren's perspective is that, capitalism, unrestrained, that it's going to cause 2008 recessions. It's going to cause a great depression and all that. And that book really sheds light. And it wasn't capitalism that caused the Great Depression, and it wasn't Hoover, bringing free market ideas. Hoover Dam. Right. That's not free market capitalism. Right.
No.
The Keynesians will make it sound like it was that caused the Great Depression. I think that's a really good lesson because the book kind of sheds light on the Keynesian fallacies that are perpetuating the myth that, what happened then is something that could potentially happen now if we deregulate and if we keep raising the rates. So it's good to have that perspective, I think.
And that was America's Great Depression. Sorry, what was the author again? Or
Murray Rothbard.
Murray Rothbard. Okay.
Yeah. I'm pretty certain that Elizabeth Warren hasn't read that book.
Okay. Yeah, we could go on the topic of what she hasn't read, but that's another podcast for another time. So now you kind of mentioned, I kind of wanted to tie into this too, because, I've invested in properties, you've invested in properties in various investments. And what I like to do, and I think any smart investor likes to, or should do, I should say, is always look at what's the exit strategy, and maybe even have multiple exit strategies. Like, well, plan A didn't work, what's our plan B? And to me, that's probably the biggest overlooked thing when it comes to multifamily, because if you're selling multifamily, it's pretty much just going to be syndicator to syndicator, bank to bank, investor to investor, fund to fund, kind of along those. Where, you and I, single family homes, whether they're in, Kansas City, Missouri, or Memphis, Tennessee, or whatever, we can sell that to another investor. We can sell that to a first-time home buyer. We can do a seller finance to the renter that's already living there. We could sell it as part of a package to the American Homes for Rent. American Homes for Rent, yeah. Right. So I think the single family route, I just think there's a lot more avenues for exit strategies than a multifamily, unless there's something I'm missing. Is there other ways to exit out of a multifamily deal other than just to another fund or syndicator?
Yeah, well, I think from the multifamily perspective, they might say, well, you could also do condo conversions, right? And that was popular pre-2008.
Okay.
I don't know if you're going to be successful doing that with like C-class property or very older built, especially with one bedrooms and all that, but that's a possibility. But that all assumes you can get separate APNs and you can get approval from the city. Doing that in like a NIMBY area, like most of California, is going to be very challenging, right? It's hard enough even to just put a shovel in the ground as is.
Yeah.
So to get them to convert a multi-apartment complex to a bunch of condos, another story. But yeah, I agree with everything you had said. And again, that's something that doesn't get talked about a lot. And I think frankly, a lot of investors, they get hypnotized because the guru talks about like all the great ways we're going to make money and everything's going to look good. And, this is what our exit cap is going to look like. And I've seen some deals where the exit cap rate is actually lower than their starting cap rate. So if you have interest rates going up in markets outside of Austin, right, then generally the cap rates would follow that would go up as well, right? Because the banks want to see that the property can cash flow. Yeah. So the as far as looking at the exit strategies, that's stress testing the deal, right? Like what's the worst case scenario? And apples to apples, like there's way more. Because the other thing with single family is it can have all the same exit strategies as an apartment complex. I have some successful multifamily investor friends that they were very active. They did very well when rates were low. When they started seeing the interest rates go up, they pivoted. So instead of buying 100-unit apartment complexes, they're buying 100 build for rent houses, all contiguous, all next to each other, right? So they have those 100 houses all next to each other. They can refinance that as 100 apartment complex. They can get a commercial loan, or they
Yeah.
can get 100 different loans, single family, or they can get a portfolio loan on the whole development. But then it's like the best of both worlds, right? You can just keep them as rentals. You can sell them to the REITs that have an appetite for that, or even the tenants, and all those strategies that you mentioned earlier.
Yeah. Well, and you kind of brought up a good point, and I'm thinking, any investment out there is going to have some risk, and I think investors, we're probably in the risk mitigation business, where there's no way to eliminate all risk, but it's like, okay, can we get a different insurance policy? Can we get a better quality tenant in there? Can we invest in only landlord friendly states and whatnot? I think of a multifamily, and yes, there's some economies of scale. You just have the siding around four walls versus siding around 100 individual homes. But I've seen stories numerous times. We even had one in Marshall not too long ago where a fire, a flood, something happens in one unit. It's kind of hard to contain. It's going to affect other units, maybe one whole floor. If someone has a leaky faucet, overflows a tub, it might affect the one below them and whatnot. Where maybe with the exception of a very wide tornado, if you have a fire in one home, like those 100 build to rent homes like you were talking about, unless it's just some huge astronomically large fire, it isn't going to just snowball and take out the other 99 homes. It's going to be pretty well contained, I would think.
Right.
So, but yeah, I don't know. That's just, again, no, one of those things I don't think a lot of the gurus really talk about. And they always say like, well, if you have only one apartment unit goes vacant, you still have 99. It's like, yeah, but you might have some idiot trying to, fry a turkey and starts a fire. And instead of one unit, now you got 5 units that are uninhabitable, and then you got to find a home for the tenant. And you got the cheap insurance, so it doesn't cover you for rent loss. So now you're negative whatever, right, $500 a month. And I think that's item number 56 that the gurus don't really talk about.
Yeah, because that doesn't sell seminars. It doesn't sell the syndications.
No.
Yeah, one thing you mentioned earlier too that I think is an important part. I originally went into multifamily thinking, okay, this is the fastest path to riches, right?
Yeah.
And this is the best way to hedge me against inflation, and then to syndicate it. This is how I can help others help them get to the fastest path to wealth and to hedge against inflation, right? But you had mentioned something about the risk mitigation, right? And that's very important, especially to family offices. So family offices, they're at a level where they're not looking to get rich quick. They're not looking for, typically they're not even looking for like 20 or 30% returns. I know there's a lot of opportunistic family offices, but Richard Wilson, who often writes books on family offices, says that most of the family offices, this is a couple of years ago, he said this, but he said most of them are just looking for like a 6 to 8% return. Their number one priority is preservation of capital.
Right.
My hunch is it's probably a little bit higher now with inflation where it's at. But you compare that to someone who, they just got off the bus and, they're at this apartment complex and they're all excited on the high and put 25K into the deal, 50K into the deal, right? Different philosophy. And, you see family offices that have been investing in commercial real estate and apartments, but they're investing in single families too. You have the hedge funds that do that too. So it's a sign that like the smart money is going into both asset classes, right? Not just treating single family the same way that the gurus treat it.
Yeah, well, and I don't think it's an either or. I mean, now multifamily kind of has I don't want to say a stigma, but different definitions. For my listeners out there in the lending world, a single family home, actually you can get a 30-year fixed loan on a fourplex or smaller. Once you hit 5 units or above, then it gets to be a commercial. You and I, just conversational, we think, oh, it's got 2 units, 3 units, 4 units, that's multifamily. But there's almost kind of little hybrids in there, if you will. Right. But I think, and maybe another obstacle for people, again, you have all these gurus just chomping on the bit, and especially where they have millions and millions of dollars in marketing campaigns. Well, if they're marketing, I'd say odds are 99% chance it's a 506c, that it's available only for accredited investors. I mean, maybe the gateway is only 25,000, which I've seen, but you have to be an accredited investor. And I've heard various stats, like only 700,000 Americans are accredited investors. But with a single family, and I don't know what your starting point was, but typically, even in this market, $150,000 home, $20,000 down payment and get a 30-year fixed mortgage. You don't have to be an accredited investor. You just have to prove your debt to income, credit score, etc. Heck, down payment you can take from a HELOC. You can take it from a self-directed retirement account. But, what was your starting point? Was it $50,000, $100,000 into a syndication, or did you yourself start with a smaller down payment?
I started with the latter. And I think there's a lot of value, by the way, even if an investor is investing passively in a syndication, even if it's a multifamily syndication, the great thing about going that route is you can borrow a lot of the methods and the processes and the systems from that syndicator that the passive investor is investing in, right? It's a great way to fast track. I kind of did it the bigger pockets route, if you will. I wasn't, I don't follow them often, but just kind of do it yourself. And, I kind of like that philosophy is kind of like counting pennies and overlooking dollars, right?
Yeah.
And nothing wrong with that. It's a good way to start, but it'll take longer, right? Like the things that really collapse timeframes, we're getting around other successful investors. And I would have made a lot less mistakes if I would have invested passively with a future version of myself or of someone else, right? Even in different asset classes.
Yeah. And I think with the passive, I think we're all, I wish more people were into passive income. I think a lot of people are just go to a job, find a side hustle, sell widgets A, B, and C on eBay or whatever the case may be. But, as far as when it comes to passive, and, you probably looked at more pro formas and more syndications than I have. What are maybe, say some listener out there, so hey, I found this 506B, I have a pre-existing relationship. The barriers to entry is lower. I only have to do 50,000. I can do my retirement account, et cetera, et cetera, et cetera. And the numbers look good on paper. The syndicator is, has rose glasses on or has blue sky projections. But with everything you've seen, what would maybe be, I don't know how word, maybe a word of caution or maybe some hard questions to ask the syndicators that maybe a beginning investor wouldn't think to ask?
Yeah, great question. A couple questions that come off the top of my head is, how can this deal fail? How can I lose money on this deal? Ask the syndicator, have they ever lost money on the deal? There's nothing wrong with asking for referrals from investors. How long have they been with the team? Is this the first time that they've been in this market? Just looking at it from that perspective, right? Because especially now, there's a very well indicator. And if I said his name, you would know who it is. But and he's one of my mentors, right? Very active in the multifamily space, and one of my investors investing passively with him. And he said that he's put a freeze on all distributions. But that doesn't get talked about, right? Nope. Today, you just still see it's still a great time to buy. There's a need for affordable housing and all that. But it's good to know that, right? And that the syndicator, it's not that the syndicator is losing money in the deal or anything like that. But the syndicator has been through multiple market cycles, and that syndicator knows that, hey, there's uncertainty, so we're going to keep the reserves over here. The asset is still good, but we're not going to just send out distributions just to because that's the feel good thing to do, right? Yeah. The other thing, back to your question, as far as, what should that initial investor do? A video that comes to mind is probably from a year ago. I'm not sure if you saw it. Did you ever see the video with Robert Kiyosaki and Grant Cardone, where Cardone came on the Rich Dad radio show?
I don't think I did. I'm gonna have to look that up on YouTube myself. So
it's very interesting because you see kind of contrasting philosophies, right? Both of them are very successful investors, and Grant has phenomenal books. Great guy, but he's very much in the multifamily, he's a syndicator, he's a multifamily investor. And his philosophy is, if you're going to start out, just invest in a fund, invest in a syndication, invest with someone who's buying these large properties. And Kiyosaki kind of had issue with that. And I strongly agree with Kiyosaki's point, because he was like, look, don't just give your money away, because what if you're investing with an idiot? You should be focusing on financial education first and foremost, right? And Kiyosaki often talks about how when he was starting out, he would look at 100 deals before he would buy one. Yeah. And then, because if you look at that, you'll get in the habit of seeing, okay, what deals make sense, what don't. And especially if time, as Jim Rohn says, will either promote you or expose you, right? You can see, how did that deal that you almost bought perform? Did it perform good, or was it worse, and all that? So I'd say financial education first, and then when the investor is comfortable, don't put your life savings in a syndication, but only the amount that you're comfortable with losing, and stress test the deal before investing.
Well, I think the stress test, you kind of brought up a good point. And, I always look for the track record with the syndicators. Unless it's a very small amount of money or there's, different circumstances, I To date, I have never put money in with a syndicator that says, "Hey, I just started. I got my license. This is my very first deal." It's like, get back to me, in 3, 4, 5 years. Let's see how you're doing. But I think society in general has this issue, whether it's the next Dogecoin or syndication or whatever. It's like this fear of missing out. I gotta hop on this deal.
FOMO.
And I've always joked around. It's like, the early bird may get the worm, but the second mouse gets the cheese. And that's kind of my investing philosophy. But I don't know what your thoughts are on that. Are you always trying to jump to the next shiny object, or do you like to see a 5-year track history, 10-year track history with the syndicator?
Well, like you, I haven't invested in any passive syndications. That'll probably be in a certain point in my life. Like right now, I enjoy being active, and it'll probably change when I have kids. But yeah, as far as like that philosophy on the trend, right? Like I had some of my investors were texting me pictures of Dogecoin back in the heyday, and they're like 18%, to the moon, Bitcoin, all that stuff. Yeah. And like something, it just doesn't sound right. I support crypto, and I think it's a great, my personal philosophy is you should be able to trade in any currencies you want. It's none of the government's business, but I don't make the rules. But something's a little fishy when it's just you're just putting money in and just magically goes up, right?
Yeah.
Nothing wrong with that, laissez-faire. But I subscribe more to the value add and being a contrarian. And Jim Rogers, Doug Casey, Simon Black, like those types of investors, they like buying, like to use the analogy of like investing in a country that just had a war, right?
Yeah.
I'm not saying that any of them did that, but one of them did use that analogy before. It might have been Jim Rogers. He's like, the best time to buy is when everyone is going this direction.
Right.
The contrarian is going the other direction, right? You have to make sure the fundamentals are there, and that's high risk. But I'd rather go kind of against the grain instead of being the last one holding onto a hot potato.
Exactly. Yeah. Your last one holding the bag is going to end up getting burned. And I think a lot of those investments, it gets to the point of this will make money if a greater fool will buy it from me. It's like, well, eventually there's going to be one last greater fool. And if that's you, you're going to be screwed.
Right. That's why flippers lost money in 2007, 2008, right? They just thought there was always going to be another greater fool. That's why multifamily sales too, not just multifamily, but even like commercial in general, like anything that was dependent on really low interest rates that's being retraded today, the sellers they're not going to get, it's not how it was like a year or two ago where they're getting, they're the darling in the bar, right? Like they are getting a reality shock right now. It's like, hey, the market is adjusting that pricing.
Yeah. And well, and I've taken advantage of lower rates too. I refinanced, 6 properties in 2020, and it was lower rates, better cash flow, more money going to principal for, equity buildup. But I've always felt that a lower interest rate should make a good deal better, not make a piss poor deal palatable. I think so many people have like, hey, if I can get a 2-point stupid interest rate, then I'll break even with this. It's like, well, probably shouldn't be going into that in the first place.
Right.
But, you did. And I kind of want to mention this, and I know you've probably spoken or, met with Ken McElroy more than I have. I first met him, firsthand, the Summit on Sand 2 years ago. But on one of his presentations, I just always, to me, what stuck with me, like, Ken, Robert, they've invested for decades. And I know Ken had shared, like, they looked at their portfolio. It's like, well, these are kind of so-so. Why don't we just test the market? Let's see about selling them. And I can't remember if it was in Oklahoma or Texas or whatever, but there was one he mentioned. It's like, I can't believe someone paid whatever it was for the property. And he was even leery, like, well, we haven't really been buying anything. We just refinanced, kept our portfolio stable, etc. And I look at it as like, Ken's been doing this longer than I've been alive, probably. He knows a lot more than I do. If I see someone smarter than me saying, I think it's time to put the brakes on, but here we are 2 years later, where I think a lot of people mistook the accelerator for the brake. Do you think the Ken McElroys are right, or the Grant Cardones are right? Like, this will just all blow over, interest rates will go down at the ninth and I'm not a big baseball fan, but end of the 9th inning, they'll be able to refinance at lower rates and everything will be fine, or the Fed will bail us out. What do you foresee come, let's just say, 2025?
Well, just Ken's perspective, and the reason why is Ken is able to, and he said this himself, he doesn't need to do a deal, right?
Yeah.
He doesn't need to do a deal to get paid. Like he's financially very well off. He loves teaching people, great mentor, but contrast that to a syndicator that is trying to get out of the job, or they need it to pay the bills. They're getting the acquisition fee, they're raising the capital, all that stuff. They want to sell it, right? And it's kind of like, it's probably a different experience. Like going to a Ferrari dealership, you're probably not going to have the Ferrari salesman like pestering you and like calling you nonstop. But if you go to like I don't know, just like a Honda dealership or whatever, a different experience, right?
Exactly.
And the reason I use that analogy, like Ken, not only does he not need the money, but he's been through the market cycles, right? And something that stuck with me a couple of years ago was when he was getting outbid on some deals. Like he's like, the way he and Kiyosaki and their investors underwrite the deals, as he explained, is they want to be able to withstand a recession. So they want to also be able to buy a deal where they can do their infinite return, which was before Burr, but Burr is kind of like a variation of that, right?
Right.
Buy a deal, do the value add, cash out, refinance, return the capital to the investor, and keep the deal as an infinite return, right? And just keep refinancing that over and over again. Well, if someone is paying higher than what they're willing to pay, that speculator is not, like Ken is more on the investor. I think the person who's outbidding Ken on a deal is a speculator. They're like, hey, I can buy it here and sell it here. And my friend Marco Pfeiffer says that that's basically glorified flipping. Like apartments, I mean, flipping is not just single family, right? Even if you're doing it 5 years or 2 years on a multifamily, it's the same philosophy. And the issue, I mean, Ken is going to be more resilient, having that spread, having the equity in the deals, having the cash flow, buying on the fundamentals, underwriting higher cap rates or higher interest rates, compared to the other investors who just think that gravy train is going to be going on forever. I think those ones are going to be more vulnerable. I think there's an important lesson in that.
Yeah, well, exactly. And I think, well, you touched on a number of good points. I remember, I can't remember which book of Ken's he wrote about it, but he did mention at the summit 2 years ago that, right before the Great Recession, if you could fog a mirror, you could get a home loan. And he was starting to look at, it's like, okay, we just turned down this person to rent a $600 apartment, but somehow they just got qualified for a $250,000 house. Something's not making sense here. And, a lot of people obviously kind of back to the speculating, the flipping, whatever, just hoping I can buy a deal and someone else will sell it. Well, that came to a crashing start. And, right, wrong, or indifferent. Yes, a lot of people were hurt with the Great Recession. But I remember Robert Kiyosaki, Ken McElroy, they even said this is an opportunity of a lifetime. They doubled down. They had cash and credit lines to buy up distressed assets. They refinanced intelligently to lower rates. And like you said, they're financially free. I mean, they're pretty much well set. A Great Depression could happen. I don't think it's really even going to affect them at this point.
Right. Yeah, and that reminds me of what you just said. That reminds me of that Jim Rogers, Doug Casey lack of philosophy, right? Like being a contrarian. So they were buying when everyone was selling. They were buying 2008, 2009, 10, 11, 12, and then a couple of years more aggressively back then. They were leveraging capital from Canada. They had Canadian investors who, their economy, their currency was stronger than ours at the time.
Oh, okay.
And were able to invest in the downturn over here. And then they put the brakes when all the stupid money came into their asset class too, right?
Exactly. Yeah. And there's even with the Fed, like we were talking about in 2020, with the stupid money where they just send stimulus checks out to Americans, it's like, I'm going to buy GameStop stock. I'm going to throw it in Dogecoin. I'm going to put in Kodak, or what was the other one? Where they're going against the shorts.
Wall Street Bets. AMC.
AMC. Yeah. Thank you. Yeah. So just like you said, dumb money. And if you can put $10 in and make $50, all the power to you. I'm very well, in that camp as well. But again, you're speculating, you're gambling, you're not investing at that point. So,
right.
So, well, I think we've hit a number of the topics I wanted to mention. And by the time this airs, I think your LinkedIn article will hopefully be published. But I think you said you're in the middle of 22 reasons why single family beats out multifamily. Was that it?
Yeah. So, and it was originally 10 reasons, and then 15 and 20, and probably be 30 by then. But yeah, that'll be posted on LinkedIn. And again, the agenda is not to, hey, buy my coaching program, or invest in my syndications and something like that. Like my passion is not to just get people to buy single family houses. I'm not a real estate, I'm not getting like a commission out of it. I'm not a wholesaler or turnkey provider, anything like that. Nothing wrong with that. We need those. But I think, with the affordable housing crisis, we need more multifamily investors, more single family, more mobile home parks, more development. We need less of the gaslighting. We need less of, hey, completely, eliminate an asset class that could be a good solution to that affordable housing crisis. And I think that's the goal for the article, is to kind of shed light on that.
Cool. So, and by the time this airs, I think I'll have that LinkedIn, or that article will be published on LinkedIn. Maybe just in closing, Sep, maybe you want to just give us one other nugget. Throw out another reason why single family beats out multifamily.
Gosh,
I know we touched base, on the exit strategies, 30-year fixed debt, just to name a couple, but maybe what's another one you can give a hook out for my listeners so they check out your LinkedIn page?
One of my favorite aspects of single family is like compared to multifamily. If you invest in an apartment complex, either you buy the complex yourself, or you invest in a syndication. Those business plans are typically not, hey, you're going to get back your money in a year. They're typically 3, 5, 7 years, right? Because it takes time to reposition that entire property. You got to renovate all those units, or most of the units. You got to do the CapEx. You have to do the repositioning if it's a value add. With single family, it doesn't take 3 to 5 years, right? So one of the strong points of that is, let's say if you're buying 10, 50, or 100 houses, if you buy some ugly ducklings and you make them look beautiful, you put in the granite, the LVP, and all that stuff, you can boost the value of those houses very quickly, like lightning fast, and refinance them individually, right? So instead of having to wait 5 years, we have some renovations that are getting done faster than my lender can even refinance it, because they require 6 months seasoning. So we buy it here, it's done in 2 months, and then we have to wait 4 months, to do the refinance. But if that was an apartment complex, it would take longer. So just another thing to consider for anyone who's doing value add.
Okay. Makes sense. Yeah. I can't exactly go to the bank. It's like, well, Mr. Banker, those 50 units we have renovated, but those 50 units we're working on, can you refinance this half of the building and we'll come back for the other half next year?
Right.
All right. Well, this has been a fun stuff. I really appreciate you taking the time out. I know you and I have similar philosophies with single family versus multifamily. But if any of my listeners want to reach out, learn what you're doing, maybe pick your brain, or maybe even invest alongside you, what's the best way to reach out?
Well, thank you, John. Yeah, my website, it's becominvest.com. I'm pretty active on LinkedIn and Facebook, so you could just Google my name from there. Happy to answer any questions or connect with anyone that either on my team or anyone that I know that might be able to be a solution. And I appreciate you for having me back on the show, John, and also appreciate you educating your listeners and doing a great service with what you do.
Well, thanks, Sep. Yeah, definitely. I'm all for financial education and financial freedom. I know you are too. And hopefully this message continues to spread out there so more people can find their financial freedom.
Definitely.
All right. Well, thanks again, Sep. It was great to have you on, and enjoy the snow in California that you're also getting.
Thanks, John. Appreciate it. Good seeing you.
Thank you for listening. Be sure to share, rate, review, and subscribe on your favorite podcast platform. For more updates, check out www.wealthandfreedomnexus.com. Remember, nothing on this show should be considered tax, legal, investment, or professional advice. This show is produced solely for educational and informational purposes. Please consult an appropriate and licensed tax, legal, real estate, or business professional for specific advice for your situation. For distribution or publication rights or media interviews, please contact the host.